Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss the recent volatility in tech stocks, why these stocks are so sensitive to interest rates, and how markets have historically performed across Federal Reserve rate hike cycles. On Friday, June 5th, the Nasdaq fell 4.2%, its largest single-day decline in over a year, after a stretch of historically strong returns. The latest episode of volatility may have caught some investors off guard. The important fact to keep in mind is that the stock market has performed well over several months, even after taking this one-day drop into account. Counterintuitively, this drop followed a strong jobs report. While that's good news for the broader economy, it's also raising the possibility of a Fed rate hike at the end of the year. At the same time, a brief re-escalation of conflict in the Middle East also added to investor concerns. Over the next few minutes, we'll put this volatility into perspective and explain why it's not necessarily a reason to change your long-term plans. First, let's look at the recent market environment. Major indices, including the S&P 500, the Dow, and the Nasdaq, have accelerated in recent months. Part of the strength can be described as a relief rally since the conflict in the Middle East has had less of an economic impact than many originally feared. Strong corporate earnings and enthusiasm for upcoming initial public offerings have also helped. Meanwhile, the bond market has faced a more challenging environment as interest rates have stayed high. The 10-year Treasury yield, for instance, is now around 4.5%. The bond market is sometimes called, quote, the smart money, since bond investors tend to closely analyze trends in inflation, growth, and Fed policy. Whether this is true or not, the bond market has been signaling that rates may stay higher than some had hoped. So it's not surprising that stocks would suddenly react to some of the same factors. Next, let's talk about why technology stocks are especially sensitive to interest rates. A clear example is the group of large technology companies known as the Magnificent Seven. From their peak at the end of 2021 to their bottom in late 2022, when inflation was heating up and rates jumped, this group lost about half its value. They later recovered as rates stabilized and went on to reach new highs. Why are they sensitive to rates? Well, investors buy these stocks largely for their expected growth far into the future. Since interest rates affect how future profits are valued today, even small shifts to rates can lead to large swings to prices. This matters because the Magnificent Seven now makes up about 1/3 of the S&P 500. Many investors may hold a larger share of these companies than in the past, which is why monitoring portfolio balance matters just as much when the markets rise as when they fall. Finally, let's keep Fed policy in perspective since market expectations can change quickly. Earlier this year, the consensus was that the Fed would keep cutting rates. That view shifted as energy prices rose and the job market strengthened. This is a reminder that the Fed often reacts to economic events rather than sitting in the driver's seat. Still, even if the current expectations prove correct, the Fed is not anticipated to raise rates until the end of the year, and only by 25 basis points. That's a modest move by historical standards, especially when compared to the 2022 to 2023 cycle. It's also not clear at this time whether this is the beginning of a full rate hike cycle, since it might be a short-term event. Either way, history shows that markets have performed well across many different rate environments, including when rates are rising. This is especially true when the Fed tightens because the economy is strong, since healthy growth supports corporate earnings. The bottom line is that recent volatility reflects the possibility of Fed rate hikes and renewed geopolitical tensions, but neither is a reason to fundamentally change long-term plans. We hope you found these insights helpful. If you would like to discuss market volatility, interest rates, or your portfolio strategy in more detail, please don't hesitate to reach out. We look forward to speaking with you.